Hey, congratulations on your matriculation here into the Apartment Academy, the multifamily industry's only operations-focused podcast and your institute for higher NOI. I'm the Dean of the Apartment Academy, Daniel Cunningham, your host here. And today's guest lecturer, our professor of the day, is Chuck Sheldon. And Chuck has been in the multifamily industry for a while and has seen the arc of how the business has changed and had some interesting things to say about what's happened recently as a result of the pandemic and the dynamic behind rent increases that I think was really very compelling, and can't wait to bring him on. Here's Chuck. Greetings, Professor Sheldon. Welcome to the hallowed halls here of the Apartment Academy. Lecture Hall Room 101 welcomes you. Thanks for joining us.
Thank you. Thank you for having me. Enjoy looking for this.
Yeah, Chuck, tell us a little about, so you're CEO, founder of TNC Management. Tell us a little bit about the company that you started.
Well, just kind of a background. My mom had apartments in Los Angeles, and I used to help her in the late 50s, and I hated it, and so I had wanted to have nothing to do with it. And so later on, I got a broker's license in '64, and I started selling properties and had an understanding for them. And then in the late '70s, I started buying buildings, and then we just said, okay, we'll manage those ourselves, and developed an affinity for it. And I retired from the federal government in '99. I started selling commercial real estate. And in 2004, things were going so well, some of my clients said, I need somebody to manage the stuff we have. And I thought, well, we can do that. And woe was me thinking about that. And so we jumped into management. And we started with a couple hundred units, plus our own. And over this period of time, we've grown it into 2,000 plus, and 80 employees. And so it's a pretty full-time business.
Yeah, I'd say that's a pretty full-time business. I think it's, having been there myself, I founded a company that about the same size as where you are now, where we grew to before we sold that company. But it is, in my opinion, far more difficult to operate a management company at that scale than it is some of the big 25,000, 30,000 unit operators out there, because it's a business with very thin margins. You don't have a ton of middle management that you can afford at that level, and a lot of it falls on you, I'm sure, Chuck, right?
Absolutely. You're very very hands-on. I had my daughter come in, and she's a corporate gal, and she was trying to help me, but she wanted to build that middle management and more layers. And I said, we just can't afford it. The margin is not there. You're looking at 5% to 8% margin as a management company. As an owner, you'll have maybe 10% margin. And so we can have both, the luxury of both, but you got to keep each separate. And the management company needs to stand on its own, and you're managing for other people and yourself.
Yeah, and I think what's happening in the market here post-COVID probably affects sort of the boutique management companies differently, more dramatically than a lot of the folks are reading about in the news that are opining about what the market's doing. But so let's talk a little bit about that, Chuck, from your perspective. Let's talk a little about what changed during the pandemic and what the post-pandemic economics have been like. Rents, costs of operations. Walk us through what that experience has been like for an operator of a couple thousand units and an owner of 1,000 units. Yeah.
So, prior to COVID, and we had tax changes. Things were getting, pretty aggressive. Margins were a little larger. Your cost for materials was down, labor was down. COVID struck. You had a direct effect to labor. So it was harder to get labor. then as we kind of navigated through that, and you had moratoriums on rent and evictions, so that limited our ability to remove people that weren't paying. So now you had large amounts of money that were owed. So that put you behind the eight ball in making payments and paying people and paying material men. And so now you're behind the curve. Coming out of that, 2.5 years, we started seeing federal government provide rents, and those subsidies didn't start coming out until 2001, when the federal government started kicking in the states to get subsidies out. Now that was able to cure some of the back payments, but there was still large amounts that were outstanding. Rent stayed flat. People were actually utilizing those federal funds to pay their rent and pocketing the money. So they created demand. So now wages go up. People are pushing to have $15 wages as a minimum. Yeah, and when you look at that, now all your labor that you're pulling back doesn't want to come back at a minimum wage, so they're coming back at $20, $22, $24 an hour. So now they're looking at driving those rates for maintenance. Now, so your labor's gone up. Materials, because of the shortage in China, because of the shortage of developing, you had a 27-week wait on an HVAC. So if something broke and you had to replace the cooling system, it was 27 weeks. The tenants were not happy. So now you had to, put those together and try to bubble gum them and tape them together and keep them working. And, then somebody says, well, that's not being efficient. You didn't have any choices. So as a small company, you don't have the luxury of saying, I can have 3 or 4 HVAC units in storage that I can put on the roof when I need them. You're, as you need them, you buy them. And, you just, what do they call that in construction terms? Meet in time.
Just in time delivery. Yeah.
Thank you. Well, that fell apart. That whole system fell apart because you couldn't get the deliveries. They were on 5,000 ships in the ocean floating around. You couldn't get the parts.
But Chuck, you're a landlord. You're an owner operator yourself. Aren't you Scrooge McDuck just diving into bathtubs full of money and why is this? Why should we care? Like, why we should get our tiny violins and play them because of the troubles you've been going through? How does this affect? What is the real effect of wages going up, of costs of materials going up or being delayed, and rent moratoriums? Talk about the actual effect on folks that on real owner operators, the small independent operators.
So many the small people that were living on that use property as a retirement platform, they were severely hurt because they didn't have the cash to come in and support themselves. Some people lost their properties. The difficulty, and you were trying to hold on, and people said, well, you have a rent moratorium, we'll give you a payment moratorium. That sounded good. But, you check with the banks and they would say, well, we'll give you 3 months, no payments, and then we'll add those together and we'll put them on top of your regular payment. So now you've increased, you couldn't make the first one, so now you have one that's, 1.5 times what it was. So that didn't make sense. So, you were trying to survive in delayed payments, survive with not giving your employees raises, and trying to be able to just hold on. So it's been a true effect to independent rental owners that are small in nature and their margins are small. So you've been pushing rents, and not until the first part of this year where people even able to push rents and start to say we need to recoup cost as the moratorium's lifted.
Now, though, many parts of the country are experiencing, although arguably we may be at the high point. Well, actually, that's a good point of discussion. But rents now have been climbing nationwide for months now. What have you seen, and what do you think will be the trend in the coming 6 months on terms of rents?
I think that in the first part of this year, people were trying to gain back what they lost. So we saw some folks, going $300, $400, $500 rate increases, which I found myself very difficult to do and say, then how are the people that are living there going to make that? They don't make that adjustment. And so we kept all raises that we did to no more than 150, and market rents were just increasing. That's subsiding. Now as you hit market levels, what we're going to see is back to a normal 2, 3, 4% increases in rent. And one of the things I looked at this and said, what's the threshold of pain that people can pay? If you're making $15 an hour, that's $30,000 a year. That's $10,000 in rent if you take a third of your rent and it can apply it from your income. That's $800 a month. So now average cost, when you look at that going across the board, are around $1,200 to $1,400, $1,500 for a one bedroom. So that means you're going to have a partner, and so the two of you can afford, whether it's a roommate, a significant other, both at $15 to afford that rent. But that's what it's going to take to make that. But that's also then the limitation on where people can be. And I'm seeing those kinds of thresholds slow down the rent.
Mm-hmm. Yeah, well, I think something that's lost on, certainly in the media, is that rents are largely driven by what the market will bear. You can't simply decide. When you say people are raising rents $500, they can only do that in the context of finding renters that are willing to pay that amount. So does that mean, does the raise in rents that we've seen imply that we have been below market for a long time, or is there something else allowing us to expand? Is it wages that rose during the pandemic? Is it savings that rose during the pandemic because people weren't paying rents? Like, what's your best guess at the macroeconomics that are allowing rents to rise at the rate that they have?
I think that the factors you're looking at, is that there has been higher demand for employees. You go to work at McDonald's, you're making $15 now. So they were at $9 before the pandemic. Now you're at $15, and you still can't find qualified people. So that's one of the factors. There was the factor of people holding back monies because they were getting federal funds to do this. But another factor that's I've been watching is that HUD, who puts out a fair market housing value for what rents should be across the United States, did not publish for 2021, and they came out in 22. So that means the last document they published was in 19. So they came out with an escalated view of the world that took your rent for a 2-bedroom from $600 to $950. That was just the federal government showing here's the market rate is $300, $350 more than it was in 19. So obviously people started saying, the government says this is what that rate is, and we'll start doing that. So that was also a driver in the market. So we look at saying, the fair market rates escalation. The limited also that's playing is that you've had limited construction over the last 3 years. So now you have more demand for less product. And so that's also driving this. And now you're going to compound that going forward with the federal government, with banking, trying to get inflation under control and raising interest rates. So now you're at 7%. If you're a large player trying to build, you probably get that down to 5.5%. But construction costs have escalated to $150 a foot in middle America, close to $200 on the coast. And so now when you build, that apartment is going to cost you $2,000 a month to rent for an 800 square foot apartment. So we have escalation built in construction. You don't have enough apartments. You're a couple of 100,000 units short across the United States. In Albuquerque, we are between 15 and 20,000 units short, with a population of 850,000. So now it has a direct demand. In every unit you build new, those rents are premium.
Well, yeah, but you can't afford to build workforce housing. You've got to build with those, especially with rates being what they are. You have to build Class A housing, or it doesn't pencil.
That's exactly right. You can't, workforce housing, and then the requirements we put on workforce housing, that we want to make sure that they are completely sustainable for, the economics of where we're going with our environment. Also puts another premium of 25% on the cost to build. So now when you look at that, you're saying you have to have 8-inch walls. You're going to have higher insulation. You have to put in multi-systems that are in workforce housing. And I look at that sometimes and I'm saying, I have a fairly nice home, 4,000 square feet, and we built it ourselves. I'm saying these new apartments are far superior to my home.
Yeah. Yeah, that's right. But so meanwhile, so rents are going. Does that mean that NOI has been going up at the same pace, or is it being offset by costs of labor and materials and that sort of thing?
It's been squeezed. It's a great question. Your return on investment is that you're seeing it drop from 6s and 7s to 3s and 4s. And, you're looking at that, and so the margin is very thin. And one of the other issues that no one took into account is that when everyone was forced to be home, they were home 24/7. And being home 24/7, what I noticed is that utilities went up from 2019 to 20. When I did that study, it was August of 21, 43%. And that was just utility use, but it was also because you were home more, you used more utilities, and the wear and tear on the property increased. So now you had these additional expenses that you could not recover. So your return on investment shrunk. And you were hoping to just keep the door open.
Well, let's wrap things up, Chuck, by giving us some advice. If you were, because you are an investor, you're and an owner and operator yourself, for those that are looking to continue to try to invest into the multifamily market, what should they be thinking about in the next 12 months, do you think?
I think that you're looking for properties that people have struggled to maintain or manage, and that's where the opportunities are going to lie. I think when you get into the marketplace and you're a small investor, and we're small investors, you buy a 30-unit, 40-unit complex, and then you take that and you have to invest $10,000 a door in order to rehab that and get it up so you can get market rents. So, but that's where the opportunities lie, in finding where those have been, somebody has struggled to the point of overcoming these hurdles for the last 3 years, going forward, and they've just given up, just worn out. Yeah, and I'm seeing that effect that's happened to people. So that's, I think, a key margin that people might be able to do that and make some money.
So still a value add play out there.
Yes, sir.
Yeah, that's great to hear. Chuck, are you soliciting? Well, let me say this in a different way. Chuck, if people want to invest alongside of you, how do they find out more about TNC and what you guys are up to?
We have a website where they can reach us or you can call me on my cell, and I answer that actually 24/7.
Oh my God! Well, of course, you're a property manager. Of course, 24/7 you have to answer your cell phone.
But they can reach me at 505-350-4110, and I answer that, and I try to help people trying to get in the marketplace, and just like we do here, and talk about what the opportunities are and how to get ready. And the other one, they can reach me email at Sheldon, that's my last name, SHELDON, at our company name, T, the word and, C, management.com. And always happy to help investors, people thinking about this. Right before this call, I was on an investor call. We just bought 100 units, and we're rehabbing that. So, we try to stay very active in the marketplace as well.
Well, thank you so much for sharing the perspective of the smaller boutique owner-operator with us today, Chuck. It is a much more difficult business than people realize, and talking a little bit about the economic impact is, I think, important for those that would consider getting into the space.
Well, Daniel, I think that, I appreciate what you're doing here, because that's helping people understand it is a great business, but it's a one you have to work at. There's no question about that.
Thank you for joining us at this week's episode of the Apartment Academy podcast. The Apartment Academy is a production of Leonardo 24/7, the industry's leader in multifamily operations and maintenance software. At Apartment Academy, we realize the hard work that goes into property management and the stress that comes along with it. Leonardo 24/7 takes the guesswork out of your team's day-to-day by providing customized daily guidance on tasks that need to be done, guaranteeing consistent operations across your entire portfolio. To learn more, visit www.leonardo247.com today.